We are now at 423. That what I see on the screen, and we may bounce a little bit more to make a top around the 440, 450 area. And then we have the final and third medium-term decline in this down cycle, probably a backtesting from the breakout point of the downtrend line from 1981, which comes through around 3% or so. I'm not sure whether we go that low, but that's the final down leg. And that down leg should end sometimes before mid-25, so probably in the second quarter. Once that is over, that will be the correction to the first upcycle in a new secular uptrend. And then comes the second upcycle in a new secular uptrend. And if I'm right and the policies remain as irresponsible as they have been, all our policymakers do is they usually throw money at the problem, and there is a problem in the economy. And the world economy is not doing well. So they are throwing money at the problem. And when that comes through, we will see inflation rising again. And then we have trade wars, we have wars, which are all very inflationary. So it doesn't mean that inflation goes up because the economy will prosper and will be very strong. It will go up for many other reasons. And I think as a bond investor, you have a last chance, probably in the second quarter, to get out. As a trader, you can probably establish a long position sometimes in early January or so for a downtrend from 440 or whatever it is, then to maybe 3.5% or whatever it is. That is a trade, and it is a risky trade because it is the last medium-term decline.
Fed Chair Powell was asked if he's looking at the 10-year yield rising as a troubling indicator, and he said he's looking at it. However, they're not really making policy around this yet. At what point do you think a rise in the 10-year, at what level or at what approximation would you think that it will start affecting Fed policy? In other words, they would take a look at that and perhaps slow down the pace of rate cuts.
Well, I do not believe that they are really interested in squeezing out the inflation because they are not prepared, politically not prepared to risk a recession. And you cannot squeeze inflation out of the system without risking a recession, as Paul Walker did in the late 70s and early 80s. So I think the Fed will come in based on what the stock market does. If the stock market sells off, they will come in because they fear the stock market is forecasting a recession or whatever. And I think they will come in on the upside once in the next cycle we begin to break through 5%. I think the Fed will try to keep 10-year governments at 5% or below, and then switch to yield curve control. And that is really a next chapter, a next Pandora box we open, because that will be very bearish for the US dollar, and it will be bullish for asset prices expressed in a declining US dollar, because that will be very inflationary as a policy.
We have to consider international markets as well if investors are interested in investing all over the world. Can we compare the state of the U.S. markets and the U.S. economy to that of Europe, for example? You wrote about Europe extensively in your last report.
Well, the Europe economy is not as strong as the U.S. The U.S. has one unique thing that has never shown up before in the U.S. economy and not in any other economy. And that is, for the first time in history, in modern history, you have a labor supply breaking below labor demand. So the supply of labor is below the demand for labor. And that has really guaranteed a full employment situation.